Obviously, I think our economy is strong. I think the elements of our economy are doing well. But my greatest fear, having been budget chairman and OMB director, is this huge debt that's out there and growing. That's going to put pressure on interest rates. It's going to put pressure on resources, the ability to be able to do the things that we want to do. It's going to put pressure on inflation. So all of those things are in jeopardy.
That was former Defense Secretary, former CIA Director, ex-Director of the Office of Management and Budget, Leon Panetta, speaking with Maria at the Context Leadership Summit in Las Vegas. Joining us now, Investmark Advisory Group Principal Michael Lee. Mike, do you agree with Panetta's assessment?
Well, I'd say it'd be better if we had less debt, but I don't think we're in a problem right now, right? You look at the U.S. debt to GDP, we're like 1-to-1. However, if you look at U.S. debt versus like the U.S. net worth, which is somewhere around $100 trillion versus $20 trillion of debt, I mean, it'd be better if we had less debt, but I don't think we're in any sort of trouble for them at the moment.
Well, so Leon brings up the point of inflation. More debt leads to higher levels of inflation. Yesterday, we got PPI. The core PPI was 2.3% year over year. Expecting core CPI for April to come in above 2%, maybe 2.2% for April. This has been a major concern for the bears in the market for a long time. What do you say to that idea that inflation could get up to 2.5%, 3%? Is that a major risk to the market?
You know, I don't think so. And I think a lot of the bears out there, it's like a whack-a-mole with their arguments as to why the markets aren't going to go higher. You know, the argument in January was like that of the movie Major League with the Don Mattingly lookalike. He hits a home run and the guys in the outfield say it's too high. No, it's just too high. There's no real underlying theme to it. So, you know, maybe the debt could lead us to inflation, but that hasn't happened in Japan. If we have inflation, it's because the economy is growing and asset prices are increasing. So for us to get to a situation where inflation is a problem, many things need to happen between now and then, creating a lot of wealth and net worth for the entire country as a whole.
You could argue that the inflation in asset prices has been a result of crazy runaway monetary policy from the Federal Reserve, which they are withdrawing, and that will accelerate as we move into the rest of the year. One thing I want to note is a story in the Wall Street Journal today that Stephanie Pomboy has talked about that is an inflation headwind for the markets, is that core prices, input prices for companies, I named Cisco as one, their freight costs are higher, and they cannot pass along all of those higher costs to their customers, so that hits their margins. Stephanie Pomboy has talked about that again and again on this program. How is that not bad for stocks broadly?
You know, yes, right, if input costs rise and inflation of input costs, but I would also say, like, how's revenue rising? So if you look at revenue rising, we're in mid to high single digits there, and then it's still finding a flow through to earnings into the mid to high teens. I don't see that stopping as the economy increases. Look, there are, as Stephanie Pomboy talks about, there are arguments, what I would say, around the fringe about things that aren't perfect, and no economic expansion is perfect. No bull market is perfect. But I'd say right now we entered this, the economy really started to take off at the end of 2012. Started really getting stronger and stronger. And there was a noticeable acceleration in November of 2016 and 2017. And we just passed the largest fiscal stimulus in the history of the United States towards the end of 2017, along with the largest deregulatory event in the history of the country. So I don't understand why more people aren't bullish right now. I go back to that Major League argument where it's just too high.
Okay, but how about why are more people not getting jobs? We have this, it's never been a better time to look for a job. Historic number of openings. Employers keep saying we can't find the workers. Labor force participation rate's still kind of low. Do you see these people coming back into the labor force the next few months, or what do you expect?
Well, of all people, Paul Krugman had a wonderful piece about this like a week and a half ago, saying because in the last recession,
your start was kind of shaky there, but okay.
Yeah, because again, Wall Street Journal editorial page, probably, I don't know, I don't read Krugman. I will fully admit that, but please continue. Give us a 2-second synopsis of what Mr. Krugman said.
His argument was that it's very hard to lower wages, even in a massive recession. So because employers are still cognizant of how hard it is to lower wages, wages haven't increased at the speed which you would like to see them. So with this labor shortage, when there's a shortage, you have to raise prices. So you're going to have to raise wages, and as wages start rising, more people will enter the workforce.
I'm surprised that Krugman just didn't say, you know what, Donald Trump got elected president, and that's why people's wages aren't going up fast enough, because that's the general argument.
Well, you know, when he wants to be, he's actually a brilliant economist, but it's rare that he lets you see that, right?
Michael Lee, thank you so much. Good to see you.